Hi, everybody. Jeff Yasteen here, answering the question today, where is the market headed? Now, I think it's headed higher for now. Enjoy the ride. I mean, every so often the stock market goes on autopilot mode, and it doesn't really matter what's happening anywhere else in the world. It just goes up and up, thanks to the Federal Reserve and other forces. That's fantastic. I hope you're invested in the market like I am, but don't get too comfortable. I mean, the end could be coming soon enough for this market rally for two reasons. Now, the first reason is something of a history lesson. So maybe it repeats, maybe it doesn't, but I think it's worth bringing to your attention. Now, back in 2000, and I'm just going to kind of go on a little time machine situation here and bring my indexes all the way back to the days of the dot-com bubble in 2000. So here's what it looks like. So back in 2000, as we all know, the dot-com bubble finally popped, and it did so in basically late March of that year. And the index fell about 2% down to here. The index, the S&P had a much lower weighting of tech stocks in those days, and the damage seemed pretty contained. And you can see here, and the market basically rallied all the way through August. As the index approached Labor Day weekend, though, that's the red circle here on the chart. Well, it came within about a percentage point or two of actually making a new all-time high compared to March. And then basically after Labor Day weekend was over with, right here, that's where the market began to fall off the table. Now, what I found weird about it at the time, I remember, was essentially that, basically the stock market kept its act together through the entire summer. But once Labor Day was over, right at the beginning of September, as soon as that was out of the way, it was as if everyone on Wall Street came in the following Tuesday and said, okay, now we're ready to sell our stocks. And as you can see on the chart here, sell they did. Every day, selling, selling, selling. Now, if we go to the NASDAQ chart, you can see something very similar. So the NASDAQ chart from 2000 looks a little different. I mean, it never came close to making a new all-time high once the bubble had actually popped. But there were plenty of people who thought that the tech stock rally was not over with. There were plenty of strategists who remained bullish as well. And there were a few economists who were predicting a recession either because of the lag in economic data. But right here, as Labor Day weekend approached, the NASDAQ was only down about 15% from the all-time highs after being down 40% at the lows. But once again, as Labor Day weekend came and went and was out of the way, that's where the real elevator ride began for tech investors. And you can see here, it continued really for the next 2.5 years or so. Now, I say all this because 20 years later, we have a stock market that underwent a huge plunge, as we all know, that seemed like it would never end, certainly for the people on CNBC. It did end, of course, in late March, and as we all know, it's been higher and higher ever since. But if we draw some lines, some trend lines, this blue line at the top connects important highs from late December 2018 and, of course, from pre-COVID, February 2020. And then we also draw a trend line underneath the rally since March, and look where things wind up right here. This is basically the lead up into Labor Day weekend. That's where all those lines converge, roughly September 4th, the Friday before that holiday. Now, just because it happened once, 20 years ago, doesn't mean it has to ever happen again. On the other hand, seasonality and market patterns repeating is something that's always there from time to time. And frankly, if the market's dynamics begin to change sometime between now and that point, Labor Day weekend, well, now you're armed with some information that may help you, one, to preserve the profits that you hopefully have from this huge, fantastic rally that we've had, as well as making sure that you don't have small losses that turn into larger losses for newer positions if I happen to be right. Now, I'll make one other observation here, and I think this is especially important if you are heavily long on tech stocks. Now, I've been showing this particular chart of the S&P 500 on my Twitter feed for a while now. It's at Jeff Yasteen, by the way, if you're not subscribing. And as I told my newsletter subscribers at the time, this is about 3 months ago as well, I want to bring your attention to this gap here, these dotted red lines on the chart. And of course, the gap was created in late February as the market sort of fell off the table, especially starting Monday, February 24th. That's between like roughly 33.02 and about 33.30 or so on the index. And that happened as Wall Street basically realized that COVID-19 was going to be a massive, important, influential financial event, so it had been pretty much ignored up to that point. So here we are more than 5 months after this gap was created, and the S&P 500, of course, has rebounded more than 45% off the lows and is now penetrating this gap space that was left in the chart. Well, why is that important? Well, the reason why is because what I've written over here, which is that gaps are made to be filled. You should be repeating it yourself. Gaps are made to be filled. A filled gap represents one of two things. One is a continuation pattern, meaning that a stock moves up to fill a gap like this one, and then it keeps moving higher. Now, if that's the case, and maybe I'm wrong about the whole Labor Day thing, it could mean that the stock market is going to go parabolic, at least in the short term, and moving even far higher than many investors expect now. But also, filled gaps can represent a reversal pattern. It's sort of like unfinished business for an index or an individual stock. It has to move first in one direction, and then when that gap is filled, it then moves in the opposite direction. Now, obviously, at this point, that could be very dangerous indeed if you are aggressively long this market. And so that's why I'm cautioning about it now. Obviously, that could be very dangerous indeed if you are aggressively long this market and unprepared. So that's what I'm cautioning about now. That's what I'm pointing out. As unlikely as it might seem, it's quite possible that the stock market has set a trap for many investors. And since the stock market bottomed in March, let's face it, the trading environment has been easy. I mean, the market has moved inexorably higher. Your main strategy has been to get long, stay long. The riskier the stock, the better you've done. And if you're an investor, that's good. It's great if you're making money. If you're a speculator, day trading stocks or focused on options, it's even better. I mean, there's nothing wrong at all with that. But we all need to be aware that the trading environment can change. And it usually happens when we least expect. That's just standard for the stock market. There's an old saying that says, no one rings a bell at bull market tops or at bear market bottoms. It's a cliche. But as someone who's been investing and speculating for 30 years, I'm here to tell you it's true. I mean, think about what the stock market was like back in March. Now, I happen to be telling my newsletter subscribers of the time to be buyers, to buy into weakness. And many of the stocks I was telling them to buy doubled in value from the lows over the past 4 months. But many of the same Wall Street strategists telling you to buy now were the same people telling you to sell back in March, April, and May, when the biggest gains were being made day after day and lots more people were on the sidelines not trusting the action. Now, everyone gets it wrong now and then, but where we really get ourselves into trouble as investors, where we really lose a lot of money, is when we allow ourselves to buy into the same story as everyone else. I mean, psychologists call it groupthink. Now, back in March, the groupthink was that the bull market was over because of COVID-19. These days, the groupthink is we are in a whole new bull market because of COVID-19. The Federal Reserve will protect us. The economy will rebound. Vaccines will save us, and we'll never again see stock prices as low as we experienced at the bottom in March. But the truth is, things are never that cut and dried. If you think that you understand the rules of the game, that buying only tech stocks is the only way to make money now and forever, because that's what's been working for the last 5 months, and since far longer than that, well, Wall Street reserves the right to change the rules. And that's why this chart of the S&P 500 is so important. It is showing you points in time where Wall Street might decide once again to change the rules. Now, maybe I'm wrong. It wouldn't be the first time. If the index, though, were a highway, this gap being filled by the index, and the trend lines that appear to point towards a potential top by Labor Day, they're like warning signs telling us to slow down so we don't miss the chance to make a great exit after a fantastic rally over the past 5 months. So that's something to think about as we go forward here. If you like what I'm talking about, make sure to subscribe to us here at Wealth Press and to follow me on Twitter at Jeff Yasteen and on the rest of social media. I'm Jeff Yasteen, wishing you the best of good buys.